Oil prices are on thin ice. After months of quiet stability, traders are warning that a massive oil glut could hit in global markets in 2026. OPEC Plus is increasing production, global demand is slowing down, and sanctions are trapping millions of barrels in limbo. The balance holding oil prices steady is starting to crack, and when it breaks, it won't be pretty. Cut to intro. At the ADIPEC Energy Conference in Abu Dhabi, Mercuria CEO Marco Dunant dropped a bombshell. We anticipate potential oversupply next year of up to 2 million barrels per day. That's not a small imbalance. That's 2 million barrels a day. That's more than the daily consumption of a country like Italy or South Korea. Why? Because OPEC Plus, the powerful balance and alliance of oil producing nations led by Saudi Arabia and Russia has agreed to raise output by 137,000 barrels per day in December 2025. Meanwhile, demand is plummeting. Sluggish global growth, high efficiency in transport, and shift in renewables are slowing oil consumption. Put simply, supply is rising faster than demand can absorb. And then it happens, the market bleeds. Part 2. The hidden factor, sanctions. Here's the twist. Despite this over risk and oversupply, we don't see a glut yet. Why? Because sanctions on Russian oil have trapped enormous quantities of crude. Tobjon Tornquist, the CEO of Gunvor Group, called it unprecedented. Through the sanctions that we have had around the world, an enormous amount of oil is stuck and dislocated. In other words, there's plenty of oil, but it's not reaching the market. The moment those sanctions ease or collapse, all that traded supply could surge back, crashing prices overnight. And it's not just Russia. US sanctions on Lukoil and Rosneft last month triggered an immediate 5% spike in prices, a reminder of how sensitive the system is to political shocks. Let's look at the numbers. According to International Energy Agency, global oil supply is projected to rise by 3 million barrels per day in 2025, reaching 106.1 million and another 2.4 million in 2026. That's a structural surge. And if sanctions lift or if OPEC Plus doesn't cut back, it could mean the biggest oversupply since 2014, when oil prices collapsed from 110 to 40 per barrel in just months. The irony, this time it's not about demand collapse, it's about overproduction meeting political paralysis. Traders describe today's oil markets as calm. Volatility is at its lowest point in a year. That calm is deceptive. Thornquist warns that volatility can flame up because of an unexpected event. New set of sanctions, new conflict in the Strait of Hormuz, a sudden recession, and any one of this could ignite another oil shock. But in an already unstable balance, it could also tip the market into a deep correction. Despite all the fears, energy demand isn't disappearing. The world still runs on oil, and according to UAE Energy Minister Suhail Al Mazouri, the coming AI and data center boom will drive even more energy consumption. The world would require more oil, more gas, and definitely more renewable energies. With AI and data centers, we need more oil. So, while the world is talking green, the reality is still black gold. Here's the paradox: the world is producing more oil than it needs, but sanctions, geopolitics, and financial constraints are keeping the bubble from bursting. That bubble won't last forever. When it pops, we could see oil prices collapse into single digits, maybe even $4 to $6 a barrel, as some analysts whisper. Pardon, maybe to $46 a barrel, as some analysts whisper. If that happens, oil dependent nations could face severe fiscal crises, while consumers temporarily cheer at the pumps. But long term, what could happen? It could destabilize markets, bankrupt producers, and shift the global power once again. The oil market is right now a house of cards held by sanctions, greed, and luck. One wrong move, and it all comes down.